What Steve didn't tell you is I'm actually sitting in the same room that used to be my office back 30 plus years ago, because I was a dairy and farm management agent here in Columbia County Cooperative Extension, and when I left to do other things, Steve came and took the job, and he's been here ever since, and I've done other things. So it's my pleasure to be here. What we're talking about tonight, the topic is using insurance as a risk management tool. So what do we mean by that? What are we going to do about transferring risk? So the purpose of insurance is to transfer the risk from the insured to the insurance company. So we're either going to transfer some part of that risk, or in some cases all of the risk. But in most cases, people insure not all of what they need insured. They insure most of what they would like to have insured, and have the insurance company take that degree of risk, and then they... So Steve, am I live again? Okay. Sorry for the inconvenience, everybody. I'm going to switch to the next page. I hope you're going to be able to see this. So we're moving to slide number 2. All right, so for the purpose of insurance, what we're going to try to accomplish using insurance is to transfer the risk from the insured, meaning you, the business person, to the insurance company. And when I say some part of the risk, for example, you'd be familiar with it in things like, on an auto policy where you have a deductible on your auto policy. In other words, the insurance company is not eating all of the loss. They're going to eat most of it, and then you have the deductible. And then if you can, in some cases, you can insure all of the risk. But in most cases, we're having the insurance company assume most of that, and you take some part of it. Okay, so insurance concerns for farm businesses. Now, many of you may be familiar with a homeowner policy. And how does a homeowner policy differ from a farm owner policy? A homeowner policy contemplates that it's just the roof over your head and the place where you live and the contents inside the home are yours, but that there are no business activities going on at the home. So when you have a farm, in most cases, the farm comprises a home and barns and business assets, cattle, equipment, livestock, crops, and so forth. So if you are just getting started and you currently have either a renter's policy or a homeowner policy, and you're actually doing some of your farming activities and you're thinking, well, gee whiz, I'm not really that big yet, I don't need a policy, don't think that way, because the moment that you start doing any of these farming activities, you've created a business enterprise, albeit very small maybe, a liability type event that could arise out of the farming activities would be excluded from your homeowner policy. So you would want to have a farm owner insurance policy to cover those types of activities, which would be the business that you're involved in for farming. Keep in mind also, flood insurance is not something that's included in either a homeowner policy or a farm owner policy. A flood insurance policy is a standalone policy. So if you are in a flood-prone area, think about whether you'd want to have flood insurance as another supplemental coverage. And in some of these storms that we've been getting in recent years, we get these tremendous rainfalls that'll be 3, 4, 5 inches in a very short period of time. And to actually have experienced flooding, you'd be surprised, and maybe you're aware of some people who've experienced this, people who live halfway up the mountainside that you would never driving by think that they're in any kind of floodplain, but they're situated in such a way so that their house may be just below a road culvert, that as the rainwaters block up the mountain stream, gets blocked up behind the road culvert, it overflows and comes down in and could flood a property. So keep in mind that, look around where you're at. You may not be in a flood zone, but if you have any kind of history to know that there's been flooding in an area because of these streams backing up, you may want to consider flood insurance as another alternative. All right, and then we're going to be talking about personal versus legal entities. Now, personal means just that. For example, David Arnold, that's me. If I have a homeowner policy, it's in my name. However, if I create a legal entity being an LLC, for example, or a corporation. So if you're doing business, say you're John Doe LLC, then you've created a new entity, and that is its own legal entity which needs to be insured as well. Now, what oftentimes happens is that you'll have a farm that the real estate and all its assets were once owned by mom and dad, Mr. and Mrs. John Doe. Then years later, the farm gets bigger and more complex, and then they have decided to create an LLC for the operating portion of it. So it's the business assets such as the livestock and equipment and the supplies and the crops and the cash flow, the income and expenses is operated under the LLC. Well, once you've created that LLC, by all means, remember to contact your insurance agent and make sure that that LLC becomes insured as well. Many times it can be done simply by adding the LLC to the existing policy as another insured. Other times, people will write a separate policy for that entity. Now, so property coverage. Property. When I say property, I'm trying to separate property from liability. When you are buying an insurance policy, the stuff, if you will, that we own in life is the property. So property could be the real estate, the house, the buildings, and then you have equipment and supplies and whatnot. Now, once we're talking about property coverage, property can be valued on what's called an actual cash value basis or a replacement cost basis. Now, most commonly, replacement costs in a farm policy would be more related to, say, the home. So let's say, for example, you have a home that was built in 1950, and it's a 2,500 square foot house. If you were to insure that house at its current replacement cost, meaning if you had to rebuild that house, and by the way, you're rebuilding in like-kind construction. So if the house had lath and plaster, for example, instead of sheetrock, well, lath and plaster replacement is obviously much more expensive than would be sheetrock. But replacement cost is just that. You're trying to insure the house to what it would take to replace it in its similar shape, form, square footage, and construction type materials. Actual cash value is something less than replacement cost. Most barns, for example, are insured on actual cash value. So actual cash value would be some number less, it could be much less, for example, than the replacement cost. And many farmers are noted for assuming a whole lot of the risk themselves. In fact, I just came from a client, one of my clients that I reviewed today, a relatively large dairy, and they're insuring the dairy barn with a milking parlor and so forth. That literally probably a third of what its true cost of replacement is, but they know that, they accept that, and it's one of the things that they do to say, all right, I'm willing to balance my risk against the amount of premium that I want to pay. Now, whether it be replacement cost or actual cash value, there are several what are known as forms of coverage that you'd want to be concerned with. So just because you know that a building or a house or something has been insured, that in and of itself is not enough to know. What's important to know is, well, okay, what kind of form of coverage do I have? What perils, what kinds of risk am I being insured against? So the vast majority of insurance companies will break it down to the first three: basic, broad, and special. Basic is just that. It's the more basic. It's, fire, wind, lightning, and so forth. Broad is another level above that, which is going to add additional peril groups, as they're called, risks that you could be covered for. And then special is the next step up, which is going to be more inclusive. So that's what most companies would use is the basic, broad, or special. There's another insurance company that sells insurance in the Northeast that's quite common, and they use a category called peril groups. And the peril groups, I believe they use up to 10 peril groups. So whatever is included in the three basic, broad, and special, they break them down into 10 peril groups that gives them a little bit more definition and ability to restrict out certain coverages should they not want to. Then the next item is it covered? So yes, you've gone out and you've bought yourself an insurance policy. You may have forgotten to discuss some item or something about your business or property that you own. Just because you have an insurance policy doesn't mean that anything and everything that you have is insured. So basically, I think it's as simple as this. When you're about to talk to an agent, write down, make a list of all the things that are important to you, all the things that you definitely want to have covered, especially in the way of property for starters. And then certainly don't be afraid when you're sitting with your agent to say, okay, these are the things I want to have covered, and you'll work together to craft a policy that meets your needs. Don't be afraid to say, well, what am I missing? What haven't I thought about that maybe you would suggest that I think about? Then there's various forms of getting these things covered, and it's under what I'm categorized as either scheduled form or blanket form. Scheduled means just what you might think it implies. If you schedule something, and where this oftentimes comes into play is like a farm has an equipment schedule. So you've got tractors and you've got plows and you've got harrows and you've got all kinds of things. If it's listed, it's scheduled. If it's listed and scheduled, then it is covered. If you haven't listed something and therefore it's not scheduled, then it's not covered. So if such and such burns up and it was not on that schedule, well, I'm sorry, but it's not covered. Now, there's a way to get around some of that, and that's by doing what's called blanketing. So instead of scheduling absolutely everything, let's say, for example, you have $175,000 worth of equipment that you own. Well, I'm going to use an easier number. I'm going to use $200,000. So let's say you own $200,000. In blanketing, you want to have at least 80% of whatever it is you have that you own insured. So in this example, 80% of 200,000 would be 160,000. Now, each year, your insurance agent is going to say, well, give me a schedule of items that you want to have supported by that blanket. And so what then happens is, so you start off with, let's say, a blanket of 160,000. That 160,000 is actually going to, in fact, insure up to $200,000 worth of items. So you don't have to have every last item per se insured. The blanket will pick up some of it. But what happens over time, you buy additional pieces of equipment, so it's useful to have a conversation, especially yearly is a good time. Upon the renewal is a good time to talk to your agent, call them up and say, you know, should we touch base on some of this scheduled equipment versus blanketed equipment? If you go out and buy, especially if you have it scheduled. If you have it scheduled and you go out and buy during the middle of the season, you buy a $40,000 tractor or whatever the item might be, by all means make sure you call the agent, because if he doesn't know or she doesn't know that you have it, you can't have it on the policy without somebody letting you know, and therefore it's not covered otherwise. And you'd be surprised how many $100,000 items are out there that were not insured because simply somebody forgot to call the agent or send an email to say, please add this. Okay, that covers scheduling versus blanketing. Now, deductibles. This also gets back to part of what we were talking about, whether you're going to have the insurance company assume most of the risk and how much you're going to take on yourself. The simple principle is this: the larger the deductible, the higher the premium credit the insurance company is going to give you, and therefore the lower the premium will be. Now, there does come a point whereby a point of diminishing returns. So if you go from a $250 deductible, for example, to a $1,000 deductible, you'll get a pretty sizable credit for that jump. You go from $1,000 to a $2,500 deductible, you'll get a pretty decent credit for that jump. And depending upon the company, their deductible schedules are different for each company, but depending upon the company, when you start getting larger deductibles, then the diminishing returns start to come in. But by all means, don't be afraid to talk to your agent about can you lower your premium by assuming that a larger deductible. That simply implies, though, that at the time of a loss, you're going to eat more of that loss before the insurance company is on the hook for their portion of what they're going to pay for you. Okay, so what to insure? We've already alluded to some of this. The home, obviously, if there is a home that is there in the business. The buildings. Now, just because there are buildings, it doesn't mean that you have to insure every building that's there. There are some buildings that, quite honestly, you'd say, gosh, I wish a bolt of lightning would strike that and burn it to the ground because I'd clean it up and get it off my tax rolls. I don't use it. So if there are buildings that you don't use and don't value, well, there's no law that says you have to insure them. If you have livestock, be it cattle or whatever the livestock are that you're in the business of, horses, for example, you may insure those. You can insure the equipment. And again, you don't have to insure every piece of equipment. And then the supplies that you're using. Some businesses have an abundance of supplies on hand, others don't have that much. And then the produce, whatever it is that you're raising for sale, or that you have an inventory to use to feed your animals. You may want to insure those items as well. Okay, liability coverage and medical payments. So we talked about the stuff part of it, the property coverage. Liability coverage and medical payments implies that you could do something in the course of your business that someone else thinks that you have in some way injured or done harm to them, that a lawsuit comes at you, and that is what the liability coverage is meant to do. To separate that out from medical payments, somebody comes onto your property, it's Christmas time, they come to your house, it's been snowing, it's icy on the steps, they slip and fall on your steps, they break their arm. They don't want to sue you, it was an accident. So they come in the house, they got a broken arm, they said, geez, you know, Dave, I need to go to the hospital, and oh, by the way, could you help me out, because my new insurance program has a pretty sizable deductible for emergency room visits, could you help me out with that? And most companies are going to gladly pay that medical payments portion, because the medical payments portion of your coverage does not require a lawsuit to get access to it. And most companies will gladly want to pay that, if for no other reason than hopefully keep the injured party happy that, yeah, gee, I got my needs taken care of here. And so they will pay for that without a lawsuit. Okay, how much is enough liability? Well, I have my own personal experience. When I was farming, I had a lawsuit that I was sued at one point in time, and if I were to tell you the story about how and why I got sued, I'm sure you would be scratching your head saying, I don't get it, Dave, how did you get sucked into that suit? Well, the point of that part of the story is to say that you would be surprised at the kinds of circumstances under which somebody can be sued, and when you are sued, they may not get anywhere with the lawsuit in terms of getting money out of you, but you still are going to need to defend yourself. And the liability coverage, when you have liability coverage through your insurance company, then in most cases, the insurance company is going to provide the attorneys on your behalf, and oftentimes those attorneys' fees that they're paying for you will be outside and additional to the limit of liability that you purchase. So what kind of limits can you purchase? Well, back in the days when I was insured, I had very little liability coverage, but that was also about 30 years ago. Today, my attitude is buy as much liability coverage as you are comfortable paying a premium for, because there is no such thing as having too much liability coverage today. Okay, now, under the activities of farming item bullet here, the reason for bringing that up is that not all activities are covered. So you have a farm policy, you've gone to an agent, you've described what you're doing, and they say, yeah, I can write a farm policy for that, and he writes you a policy. A few years down the road, you go off onto another tangent whereby you're going to do things like, if you notice down below, you may start going to farmers markets, selling your goods there, or having agritourism occur on your property. So by virtue of the fact that you already have an insurance policy does not mean that any and all activities that you're ever going to pursue are automatically covered. Some policies are going to exclude certain items until such time as you buy an endorsement to add that activity back in. So, but the normal farming activities, raising livestock, raising crops, raising fruit, those are defined as the normal activities of farming, and liability is going to follow that. It's when you get into these other sort of activities that you may need to get additional endorsements added to it. So just if you remember anything from this, don't be afraid to contact your agent even before you've entered into some of these, because you may have an idea that, gee, you know, wouldn't it be nice if I do such and such? Well, it may be nice to do such and such, but you may have great difficulty getting liability coverage for that. So just find out whether you can get covered, and if so, what's it going to cost, and work those costs into whether maybe this side venture is not going to generate enough revenue to really justify the liability coverage for it. Raw milk sales is something that used to be very common practice, especially as a kid growing up. I mean, you know, people would go down to the next door neighboring farm and they'd dip the milk out of the guy's tank and put it in a glass jar and bring it home. Those days are over in terms of getting liability for the sale of raw milk. And the reason that that is becoming problematic is because of what's known as the products liability. So when you buy pasteurized milk at the store, the milk is gone from the farm, it's gone to the milk company. The milk company, as soon as they get it, they run it through a pasteurizer. It's going to hopefully be killing off most all of the bacteria and organisms that might cause you health and illness. Whereas raw milk sales is just that, it's raw. So whatever bacteria and so forth are in the milk and pathogens that might be there at the time, well, they're still there. And so if you take it home, and you drink it, and you become ill from that, and the doctor says, well, it was most likely perhaps it could have been listeria, for example. Insurance companies are getting more and more wary, and there are no companies that I'm currently aware of. That's not to say that there aren't out there. There are no companies that I'm aware of, certainly none of the 7 that I can write with, and some of the others that I'm aware of in the area have all put exclusions for raw milk sales on their policy. Now, there are companies out there who will write standalone liability for that exposure, but many of the farms, and I'm sure you may be aware of them, there are farms that are still selling raw milk, and so what's happened is they, meaning the farm themselves, hopefully they're aware of the fact that it's excluded, but if they're still selling the raw milk, they're going to be assuming all that liability should somebody get sick and come back at them for an illness because they got sick. And then the sale of meat. Again, activities of farming, if you're raising livestock, be it beef or pork or poultry, the fact that you raise that animal, that's part of the activities of farming. If you sell that animal live, either at the auction or to your next door neighbor live, that's an activity of farming. The liability is following that animal up to the point of sale. The moment that you take that animal, so you own the beef steer, you send it to a slaughterhouse, you have it slaughtered, cut, and wrapped, processed, and you put your own label on it, and then you sell that. That's no longer an activity of farming. That is a processed product. In most cases, you can get liability coverage for that. And again, it goes back to this products and completed operations coverage. So if you're thinking of doing that, by all means, ask your agent if you can get products coverage for the meat sales. And in most cases, you're going to find that every insurance company is going to want to have that animal slaughtered at a USDA inspected facility. Okay, contracts with others. So under that, you could be owning the farm that you own, and yet the farm doesn't have enough acreage to provide you all the tillable cropland that you want to use, so you go down the road and you rent 25 acres from your next door neighbor. And it's not unusual, especially in places like the Hudson Valley, where there are a lot of non-local weekend residents who have come up from the city or the lower part of the state, the more urban areas who have weekend farms, and some of these farms are pretty fancy, pretty elaborate, and lots of acreage. You can be certain that if it's owned by individuals such as that, it will be very common that they will ask you to name them, the owner of the land, as an additional insured on your farm owner policy. And so what does that mean when somebody is an additional insured? So if the landlord that you're renting from wants to be an additional insured, so you're out doing work on their property, something happens while you're there. For example, let's say you're baling hay, renting hay ground. You're baling hay, it's getting late in the afternoon, early evening's coming on, the dew is starting to set back in, the hay's now just a little too wet to bale. So you leave the tractor and the baler there in his field. Somebody comes over, picks you up with a truck, takes you home. The next day, once the dew has evaporated and the hay is dry enough to bale again, you'll go back out and start baling. Well, in the meantime, overnight, that tractor's sitting on, not on your property, but on your landlord's property. Some neighborhood kid thinks it's going to be fun to take this thing for the joyride if he can figure out a way to get it started, and he does. And he gets in some kind of accident, he gets injured. So you are the owner of the tractor and the baler. Well, you can be certain that you're going to get sucked into that lawsuit. But the owner of the real estate that you're renting from, and especially if it happens to be somebody with a lot of their own equity and assets, and it's on that individual's land, they're going to get sucked into the lawsuit as well. So being the additional insured simply means that your insurance policy is going to also have to represent your landlord in the lawsuit. Now, the downside of having additional insureds on there, let's say you have $1 million limit of liability coverage on your policy, and you have an additional insured, your landlord. Both of you get sucked into this liability lawsuit. You did have $1 million limit of liability. However, if the judge, jury, or whoever is making the final decision determines that, yeah, both of you have some degree of responsibility here, and they say that you, the farmer, assume 75% of the responsibility and the landlord is assuming 25% of the responsibility, and the award was at least $1 million or more, then your $1 million, they're going to pay out $750,000 on your behalf, but the landlord actually gets to tap into your policy to the tune of, in this example I'm giving you, up to the $250,000. So it does water down your policy somewhat. Okay, on hold harmless agreements, what are these? So if you have contractors that are coming to your property doing some work, they're building a building for you, if you can, get a hold harmless agreement, which is going to be something that says that while this contractor is doing work for you, he or she, the contractor, holds you, the landowner, harmless to anything that happens to them while they are working on your property. Insurance certificates are really important. When you're hiring people to come work for you, so if it's somebody that's building something for you, find out, do you even know whether they have insurance themselves? And you really today, anybody who is not carrying liability insurance, yes, there are a lot of small contractors who are very good, but they work out of the back of their truck and they don't do, you know, gangbuster business, but they're competent and they do a good job. They may not be insured. So if in the course of doing business on your property, they do something that creates some kind of liability event, well, then you would want to know that they have liability insurance as well so that you're not going to be on the hook for the total loss. Okay. All right. Liability continued. There is such a thing as known as an umbrella, also sometimes known as an excess liability policy. An umbrella policy, the word umbrella oftentimes gets used sort of loosely in insurance, but what an umbrella policy truly means is that it is a standalone liability policy. And it comes into play when and only when an underlying policy has been tapped because of a lawsuit. The lawsuit continues through the courts, and it eventually comes to fruition that they end up paying out the maximum limit that that underlying policy carried. So let's suppose that it was a farm owner policy, and the award was for $1,800,000. You had a $1 million limit liability policy coverage on your farm policy. Then the injured party has still got his hand out and says, "Well, you owe me $1,800,000, so there's an additional $800,000. Cough it up." And so you could say, "Well, gee, all I had was $1 million liability coverage. That's all I've got." The injured party says, "Well, I don't care. You have a lot of assets. You've got this very valuable farm and a lot of assets, and we've already discovered this, so cough up the funds however you want to cough it up. I don't care. Start selling assets." So instead of having to be forced into that kind of situation, an umbrella policy then would pick up the difference up to its limit. So let's use the example that I just gave you. The award was for $1.8 million. You had a $1 million limit liability on your underlying farm policy. You had another $1 million umbrella limit of coverage. Then that umbrella would be sufficient to pick up the difference of the $800,000. Keep in mind that an umbrella, though, does not pick up any and all types of liability. So if, for example, you have a policy for a farm owner policy and it's covering the activities that you have been active in, but then you go off and do something different that is excluded from your farm owner policy, it's not covered by your farm owner policy. Even if you had an umbrella policy, that umbrella policy is not going to cover that other activity that was not already covered by your underlying policy. So the kinds of policies that can fall under this umbrella, you can imagine that you're standing there holding an umbrella. Underneath this umbrella is going to be your homeowner or a farm owner or a personal auto policy or a business auto policy. So to extend that analogy to you're driving on vacation in California with your personal auto, and you get in an accident, you were responsible for injuring somebody badly in that accident, then that policy pays out its limit. There's excess required of you. Your umbrella policy could go over the top of that. Okay. All right, business autos versus personal autos. It's not unusual for people to have, especially the larger the business becomes. When the business is small, just starting out, it's not uncommon to just have your own personal auto and maybe a pickup truck, and it's on your personal auto policy. And that actually is all right. That's fine. As you grow your business and maybe you've got more vehicles, or if you have created an entity, an LLC or a corporation, if you've gone to the effort of creating business entities, the business entities also help to isolate you, insulate you, if you will, from some of the liability of the business activities. So if you've created an entity and you have an auto, I would at least move one of your vehicles, or if you're growing the business, buying new vehicles, have them titled and registered in the business entity name. But the item that I have the bullet point here under this heading where we've got a subheading of hired and non-owned auto. Hired and non-owned auto is a coverage that you could only buy. You would not be able to get it from your personal auto policy. You would get this through your business auto policy. And what hired and non-owned auto is this. So let's suppose in the course of your farm business, you actually hire somebody to truck livestock or truck produce or truck whatever it is you need trucked. And that individual comes to your farm, picks up whatever the goods are that you want trucked, and he's taking it somewhere. That individual gets in an accident down the road. That individual has done harm or injury to somebody that they injured, that they caused or they hit in the accident. He gets sued, so your common sense would say, well, that's his problem. That's his liability, not mine. And his auto policy would be tapped for that liability exposure. But attorneys today are going to look for as many deep pockets as they can find. And they're going to look to see, well, gee, you were a truck for hire. Did you have anybody's produce or products on that truck that you were carrying? And so then they find out that you and your neighbor and the next neighbor down the road all had produce or animals, livestock on that truck. It would be very common for an attorney to say, oh, all right, well, let's also sue the people who had the produce or livestock or whatever was being carried by that trucker, because the argument could be made that, well, had it not been for your livestock or your produce having been on that truck at that point in time, that accident would not have occurred. Therefore, you're in some way partially liable. That's the hired part. So if you have a business auto policy, you can get hired auto coverage on that. Just because you have a business auto policy, if you do go to your agent and say, I want a business auto policy, it's my professional opinion that I think any business auto policy is worth also having the hired and non-owned auto coverage on there. Now, what's the definition of the non-owned part of this? So the non-owned could be that you've got an employee who works for you, or it could be your mother, father, brother, and you say, Joe, Mom, Dad, whoever it may be, you're going into town today? Yes. Stop at the hardware store and pick up 5 pounds of 10-penny nails. I'm working on putting some siding on the barn or whatever it is you're doing. They get in an accident. You haven't hired that person. They're doing you a favor. So the same scenario could play itself out. They're going to get sued. Their auto policy is going to respond. But if an attorney finds out that that individual is doing you a favor and bringing something back to the farm on your behalf, then that would be the non-owned part that your business auto policy could pick up and provide you with liability coverage. Okay, workers' compensation. In the state of New York, as best I recall, the current requirement, threshold requirement to carry workers' comp is only $1,200 per year. And that does not mean $1,200 of cash or a paycheck. It could also be if you're exchanging product or services. So this individual could be receiving whatever, trading their labor for produce that you raise on the farm, and they're getting paid in the form of produce. It does have a monetary value. You guys, the two of you, have figured out what that fair exchange is for goods and services. So at that $1,200 threshold, you should be carrying workers' comp. Now, while I'm talking about that, there is a really superb cooperative extension publication called Farm Labor Regulations. And it was printed back in 2002, I believe. And the author is Dale Grossman and Jason Minard, M-I-N-A-R-D. If you did a Google search and just put in New York Farm Labor Regulations, and I don't even think you have to get to the author's name, and this publication will pop up. You can digitally download, and it's going to have most everything you want to know about what you're required and not required to be obligated to with regard to farm regulations for labor, workers' comp, disability, et cetera, et cetera. Okay, some of the other things that you may give consideration to within regard to insuring your farming activities. Crop insurance is simply insuring against the loss of a growing crop due to weather or disease. Some people buy it, some people do not buy it. It could be drought, it could be weather extremes, it could be flooding and so forth. It's one item you may want to consider. Disability insurance, although it's not per se related to farming, it's related to what could happen to any one of us in life, and that is that you are insuring against the loss of income due to a disability that occurs to you. So if in some way you become physically disabled and you can no longer perform some of your working activities as you once did, consider the possibility of disability insurance. Other insurance you may want to consider thinking about would be life insurance. Life insurance, there are many reasons why people buy it. One would be to pay down debt at the time of the death of a family member. So if a spouse dies and there's still the family, the farm business, whatever you have a mortgage on or a large degree of debt, the death benefit could go a long way toward reducing or eliminating that debt. Also used for securing families' futures. I mean, very young families oftentimes think about this. So if, God forbid, a young spouse dies and there's a very young child or children in the family, this also helps to make life a little easier for the family members. Now, I want to distinguish between types of life insurance policies. Term policy versus a permanent cash value policy. A term policy is, some people call it renting life insurance for the duration of the term. You can buy term insurance for 5 years, 10 years, 15 years, 20 years, 30 years. The older you get, the shorter the duration of the term. So if you were 70 years old, you couldn't go buying a 30-year term policy. If you're 40 years old, yeah, you can probably buy a 30-year term policy. So what happens is you buy a death benefit amount, $100,000, $200,000, $500,000, $1 million, for that period of the term. Term insurance is the lowest premium type policy that you can purchase. all that it is purchasing is a death benefit. So if you were to buy a 20-year term policy, and if unfortunately you do die during that 20-year term period, then the death benefit gets paid out to your beneficiary. If at 20 years and 2 days after that you die, that policy term has expired, there is no more death benefit, and you have paid that premium for the 20 years. And yes, you had the peace of mind of knowing that you were insured during that time, but that premium is gone forever. Now, you can compare and contrast that with permanent cash value life insurance. And permanent means that it's going to be there for as long as you live and as long as you're paying the premium to satisfy the cost of the insurance. It's going to, in addition, build a cash value within the policy. So there are two components to this. Yes, there's going to be a death benefit, but yes, there's going to be a living benefit to you or your family members as well in the form of the cash that's within that policy. So the cash, under the benefits you see here, the cash is going to grow tax deferred, and it may, depending on how you take it out, may come out tax free. So if you're putting, and I have for myself, I have two of these such type policies where I put in fact, I do what's called overfunding it. I put in more premium than is required to keep the policy active for just the death benefit, because I want it to grow. I want it to grow a tax-deferred benefit within there that I can use during my lifetime. And what I will do, and you can borrow against that cash value. You can borrow against it at very nominal cost of borrowing. And the beauty of doing that is that if you needed to borrow money from somewhere and you had a cash value in your life insurance policy that you could borrow from, you simply call up the insurance company and say, how much cash value is in there? And they tell you. And you say, how much can I borrow? And they tell you. And you say, fine, send me $30,000. And they say, okay, it's in the mail tomorrow. Now compare that with going to the bank. You want to borrow $30,000 at the bank. It's a lot longer drawn out process. And when you do get the loan from the bank is going to have a very structured loan payment. They're going to want so many dollars a month, and it's going to be for so many months, so many years, what have you, and you need to make that payment every time. So if you have a business whereby your cash flow swings, sometimes a lot, if borrowing from your cash value of your life insurance policy makes sense to you, you have an unstructured loan payment schedule, meaning there isn't any real schedule. Yes, there's going to be an interest that's accrued being charged to you, but if that's all you want to pay for a period of time, once a year they'll send you an interest bill, you write the check for the interest, and if 2 years from now is when you now have the cash flow to start paying that off, then you can start paying it back. So there are many advantages to doing that. And then what I personally will do is, although there's a death benefit because I have overfunded this, meaning I put more cash in than I need to, I've grown the cash value on a tax-deferred basis, and then when I choose to retire, I'm then going to start withdrawing some of that cash benefit to supplement my retirement monies from other sources. So permanent cash value life insurance has its place. It's considered an asset. In fact, when you go to a bank and borrow money, they may ask you what cash value life insurance you have, because they're considering that as equity. All right, and then again, one of the last bullets is that it gives you liquidity, use, and control of that cash value. Okay, another type of insurance, again, this isn't related to farming per se in any way, but any and all of us may have a need for this, or we may have a parent or grandparent who might be in a situation one day whereby long-term care insurance may be a solution for a long-term care need. So by that, what do we mean? Long-term care needs are when you have a chronic health need and you have lost what are called activities of daily living. And the activities of daily living are highlighted here: eating, bathing, dressing, toileting. Transferring means the ability to get yourself say from a bed to a chair or on and off in the bathroom, for example, into the bathtub and out, and then continence. So if you have lost 2 out of those 6 activities of daily living, and you were to have a long-term care policy, then you would be eligible to be receiving the benefits of the policy that you purchased. Again, why do people buy this? Peace of mind of knowing that long-term care can be exceedingly expensive. In this area, it's nothing to think of a $300 a day facility care cost, and this could go on for years, 2 years, 3 years, 5 years. So you can go through a whole lot of family assets in a very short period of time. So some people buy long-term care protection to protect the assets, to preserve those assets for a younger generation, for example. And then other people say, you know, I just don't want to be a burden to my family. I mean, what would happen if I did not have the ability to pay for this through some other means, and I had to rely on my adult children to come live with me, sometimes even quit their job to move into the home with mom and dad to take care of them. And they say, no, I don't want to put that burden on my children and my family. So that's another reason why some people would buy long-term care insurance. That's essentially what I have to discuss. This is my contact information, and I'm certainly open for any questions. So
we do have a few, Dave. Can you recommend some companies that work with agritourism in Hudson Valley, perhaps some that are willing to work with new businesses?
Well, I guess I would have to know the definition and what type of agritourism it would be. Some companies have a tolerance for example, corn mazes. Corn mazes, some companies will accept that, but they will be very specific about how those things are managed. They would want to have an elevated observation tower over the maze so that they can look down. If people are in there, they can see them, they can find them. If somebody gets lost or to trip, they would want to make sure that the corn stubble is mowed right down for the path that they're going to be on, is mowed right down to nothing, so that they're not going to be tripping over corn stubble while they're walking through the corn maze. So I guess what I would say is, because there is so much variation from company to company, what one company will tolerate and another company will not tolerate, there's no substitute for just calling the company and say, this is what I'm looking to do. Will your company insure that type of exposure? I'll give you another example. People coming out for pick your own exposure, be it for apples, be it vegetables and so forth. Many companies will allow picking of fruit from the ground. So if you have these dwarf and semi-dwarf trees where you can simply reach up and pick the fruit from the ground, many companies will say, okay, we're okay with that. We'll put a charge on there, a liability charge on it for that. But the very same company will say, we absolutely positively will not provide liability coverage if the farm is using ladders to allow the guest to climb up into the tree to pick fruit. So rather than to give you a company by company, there's just so many different risk appetites between these companies. There's no substitute for just calling them up and saying, this is what I'm looking to do. Can you cover that?
Yeah. And I think you're bringing up the point, Dave, that it doesn't hurt to shop around either.
Absolutely.
To see what kind of coverage you can get from an insurance, through an insurance agent, and then what is it going to cost me? So
yeah, and you may not, and especially if you're just starting this up as a new enterprise and you don't already have a business in place. If you're starting it up as a new enterprise, call around to several different agents if you want to, and give them, have a well thought out set of notes as to the kinds of things that you are immediately planning to do and the kinds of things that you may do down the road. And then if you have a time frame of the things that you may do down the road, well, if the maybe I'll do this, well, maybe if it's going to be 10, 15 years from now, I'm not going to be concerned about that. Get insured with a company that can handle what you're doing right now. And, you know, once you get into business, some of these other things may arise at that point in time, and then see if they can still continue insuring those activities. But if you know that you're going to evolve relatively quickly, say to your agent prospect that you're talking to, and talk to a couple different ones, and talk to people and get a sense, get a feeling of how comfortable you feel with them. Like doing business with anybody. I mean, how comfortable are you going to be? How easy it is for you to communicate with them, and how knowledgeable do they seem to be about what it is you're doing. And now I want to make a distinction between agents and brokers. I happen to be a broker, and a broker by definition has the ability to write insurance with multiple different companies, so we can broker it through company A, company B, company C. Some agents are known as captive agents, meaning they work for the XYZ company, and they sell only insurance for the XYZ company. Now, that's not a bad thing. It just is what it is. So when you're speaking with that individual, they may be able to say, well, this is what our company can do, and if that meets your needs, fine. And when you're talking to a broker, he may say, well, if you were talking to me, I'd say, well, I've got a company that can handle this part of your business, but he can't handle the other thing you're talking about. So therefore, I'd be inclined to go with company C. So there's a lot of variation out there. Talk to as many different agents as you feel you need to get a sense of where you feel comfortable, and then if you feel comfortable with this agent and what they can do for you, then say, yeah, I'd like to meet with you and prepare a quote.
Great. Another question was that we have 10 acres in pasture that is cut and baled by a neighbor in exchange for half the crop. What is our risk? They do have liability insurance.
Okay, so the individual that's asking this, they own the 10 acres, and they're crop sharing, if you will. The neighbor is baling the hay on their property, and in exchange, this individual who owns the 10 acres is getting half of the hay. Is that right?
Correct. Yep.
Okay. Now, if the individual, what I would say is to ask the person who's doing the baling to provide you with a certificate of insurance, and that certificate of insurance will show the name of the individual, and make sure that when you see a certificate, it's going to show the current effective date. So let's say his policy expired April 1st of 2015, and he's baling hay for you June 15th of 2015. That previous policy has expired. Make sure that you're getting a copy of a current in-force policy. Now, to be specific about these certificates of insurance, if, let's say, somebody asked you that you needed to provide them with a certificate of insurance, you simply call your agent and say, Dave, I need a certificate. And the important thing that the agent needs to know is who the certificate holder is going to be. So in the case of this example right here, the individual who owns the 10 acres, they're the ones that want to be the certificate holder. The individual who's baling the hay on their property, they're the ones going to provide the certificate. And if you want to go to the extent of asking that person who's baling the hay to name you as an additional insured on his policy, well, then you could also do that. Not saying you have to, but it's an extra layer of protection for you if you do.
Okay. The question about workers, oops, got a big question here. Is the $1,200 for workers' comp per year for individual or total for all farm employees?
All farm employees.
Okay. Insuring animals. What about guard dogs or herding dogs? My husband wants to get 2 Australian Shepherds to protect our future chickens from predators like coyotes, foxes, and hawks. Is there any kind of insurance that exists for these type of animals?
Honestly, I don't know the answer. I've never had anybody ask me that question. I never insured a guard dog before. My guess is that you may have $750, $1,000 invested in some of these. I mean, depending upon the breed. I honestly don't know. I've never had anybody insure a guard dog before. So all I would say is call the agent that you'd be doing business with or are doing business and find out if they've got an outlet for that.
Okay. let's say we have a similar situation with bailing on a larger scale with a family that has been doing it for decades before we bought the property. A handshake deal was all that was provided, and they bailed the hay. Is there some kind of waiver that we can arrange between us and them so that both our home hold harmless for each other?
Well, certainly you can draw up hold harmless agreements. What I don't know here is whether this party that has been doing the hay, I'm kind of guessing here, if it's on a larger scale, then I'm kind of guessing that the family that's doing the bailing has an insurance policy and has, if they have a farm, if they have a true farm and they're actually farming, then it's highly probable they have an insurance policy. And if they have an insurance policy, you can, and even though it's a handshake, and I know it starts to go with, we would all love to go back to the time when everything was done on a handshake, and Joe's a good guy and I trust him with my life. But unfortunately, we don't live in that world anymore, in terms of there's just way too many people out there who believe that it's just too easy to sue people for things that go on. And so you're not really insulting the person by saying, I don't trust you. It's not as though you're saying I don't trust you. Blame it on your insurance agent if you want to. Quite honestly, say, listen, my insurance agent said it's really a good idea. We'd like to have a certificate of insurance from you. Now, if he says, I don't have any insurance, well, then it's still up to you to decide how well you value that relationship, and you may still value that relationship. And you may just say, well, okay, I guess we'll still continue doing it the way we've done it in the past. It's something that you've got to decide if you're willing to accept that.
Okay. Karen says that answers that question. She does have another one, though. They have an inclination to let people go through the natural landscape and to seek out unique apples, old heirloom trees. The paths are well tended, but should we have a waiver there for people stepping onto the property, or just up the liability coverage in case minor injury, like a twisted ankle, happens?
Well, I'm a little confused by, so is this a fruit farm that's allowing people to wander through the property, or is it there just happen to be old heirloom apples out in the woods that still exist from 100 years ago? And are these just, nature seekers just walking through? In a way, it doesn't matter. If this person asking the question has a farm business and they have their own farm business policy, I would suggest, first of all, the old heirloom trees are going to be trees that you're not going to be picking from the ground unless there happens to be one low branch. I would highly discourage, I would more than highly discourage, I would say absolutely nobody is to climb these trees to pick apples out of these trees. And then again, getting back to, or just up the liability, as I said before, my mantra is there's no such thing as too much liability coverage. If you can afford to pay the premium and you're comfortable with that, have all that you can get. The twisted ankle and things of that nature, again, liability, if it's just a twisted ankle and they come out and they're hobbling out of the woods and said, gee, I need to go to the doctor, that's where the medical payments part of your coverage that we talked about earlier, and just contact your insurance company and say, so-and-so twisted his ankle, here's the bill for his deductible and on his emergency room visit.
Okay. If she's comfortable with that, I would just ask Dave, does signage, is signage a good thing to guide people along a path that maybe, so that they're hopefully sticking to the path? Of course, people don't. Do any of the signs, which kind of, cautionary sign that says that, walking in an old apple orchard can be hazardous, and these are some things that could happen?
Well, I would like to say that all of that is a good idea, and certainly it does no harm to have them there. Speaking of signage, for example, yes, I would. Yeah, sure. There's nothing wrong with it. I would do it. Now, how well that's going to hold up in court if somebody really got injured badly and they were inclined to sue you, is that gonna make a watertight contract, so to speak, that will get the lawsuit dismissed? I doubt it. But it certainly helps that you have made people aware of some potential hazards which are on your property. And beyond that, I can't say that it's going to be ironclad and keep you out of trouble, but certainly I wouldn't discourage you from doing it. Just as, for example, having no trespassing signs on your property if you don't want people hunting on your property, for example.
Right. Can you have people sign a waiver if they're coming on and you know it, that it's during a scheduled time of the year, like typical harvest or apple picking time? Would having people sign a waiver help in any way? Again,
signing a waiver, I think, is a good thing in the sense that you have at least, by making them sign the waiver, you brought to their attention that there are some risks here. And the signing the waiver, you have made an effort. So you have actually shown responsibility as the business owner to make aware the customer or client or the passerby who wants to come visit that there are some hazards out there. And so it's not as though they just stumbled across something that you didn't make them aware of. Now, all of this is a good idea. However, let me just play the flip side of this. And if you have a property that has just junk and stuff strewn all over the place, that it's, and you've seen places like this, you drive by and you see junk cars and junk carcasses of equipment all over the place. It looks like a trip and fall waiting to happen. Then none of this stuff is going to do you much good. And so the point being is, and quite honestly, there are insurance companies today that if you've got 2 or 3 unregistered cars that are just sitting in your yard, they're not registered, they're not being driven anymore, there are companies who simply will not even write your property coverage for that any longer because they don't want to get sucked into the liability that can occur from kids playing on the cars. That being said, that car which is unregistered and sitting in your yard and does not have insurance on it, your homeowner or your farm owner policy is not going to provide liability for somebody who climbs onto that vehicle and falls off. You need auto insurance for that, believe it or not. So,
all good. That's very helpful. Are there any other questions, folks? This is your chance.
I will interject one thing I did not discuss before, and I think if we do this again, Steve, I would be inclined to add another slide in here. And I don't know whether any of the people in this webinar have any interest in horse farms and whether they would be entertaining starting some type of boarding or breeding or training or lesson business. New York State is one of the few states in the United States that does not have what is called a state equine law. You go to most any other state, you go to Kentucky, you go all over the place. In fact, my wife and I went down to Kentucky 2 years ago and bought a couple of horses. And while we're down there, every facility, every farm you go to, there's a big, big sign plastered all over the wall. It says, this is an equine facility, and under the Kentucky or South Carolina or North Carolina law, you recognize that if you're on this property, you understand that being around or working with horses is can be inherently dangerous. Therefore, you accept any and all risk. And basically what that does is it reduces the potential liability to the farm owner. New York State does not have such a law, and the horse industry in New York State has been, pardon the pun, chomping at the bit for a long time trying to get the legislature to pass such a law because it makes it exceedingly difficult for those types of farms to get liability insurance in this state. And when you can get insurance in this state, yes, there are companies that will write horse farms, but because the insurance company knows that they're potentially on the hook for what could be a very large lawsuit, then the cost of liability insurance for a horse farm goes up quite a bit. So in fact, any companies that I have that would write a horse farm in New York State is going to require that as part of writing that insurance policy that that you, the client, are going to need to provide the agent and then to the insurance company a hold harmless agreement spelling out all of these things, saying, basically, in essence, saying what New York State law does not say. And is it going to be ironclad? Is it going to keep you out of a lawsuit? No. But you can put a lot of teeth in there to make the customer aware, and that will be helpful to you in a lawsuit.
Okay. Very good points about equine for New York State. I haven't seen any other questions come in, Dave, so I think we're all set for tonight.
Okay. Well, it's been my pleasure. I hope this has been beneficial.
Yes. Thank you very much, Dave, for presenting once again on insurance for our class. Next week, we are going to talk about business structures. Yours truly will be conducting that. And as usual, if you've got any questions or comments throughout the week, feel free to get a hold of Lynn or myself. So thank you all and enjoy your evening. Bye-bye.
Good night.
Dave, there is one more question. Is it cheaper to use umbrella policy or just increase your limits on your insurance policy?
First of all, an umbrella policy is going to require that the underlying policy, be it the farm owner or homeowner if you're not in a business, your personal auto or your business auto, they will require that those underlying policies have to have a certain minimum limit. For example, one of the companies that I'm writing with now will require that if you have a personal auto policy and you want that personal auto covered by the umbrella, it must carry a 500,000 combined, what's called a combined single limit of liability. So if all you're carrying right now is a 300,000 combined single limit, you're going to have to automatically raise that underlying auto policy to 500,000 before the umbrella will even cover it. And then if you want the umbrella over the top, you certainly can. These umbrellas don't have to be terribly expensive if it's not a terribly big business, and all you're insuring or all you're putting the umbrella over is the farm business and, say, a car and a pickup truck that's like a 3/4 ton pickup truck. You might get that for $175, $275 a year for that extra $1 million limit of liability. So I would first always encourage you to carry a reasonably good limit on your underlying policies. Once in a while, you'll actually find a company, not many, but some companies will give you a $1 million limit of liability on a personal auto.
Wow. Wow. Okay. All righty. That was the last question, so I think we're all set.
Okay.
Great. Thank you very much.
You're welcome. Good evening.